Good morning, good afternoon, good evening. Whenever you are, wherever you are, thank you for taking the time for joining me in this month's Zenith Portfolio Market Update. This is the market update for the month of June 2026, and it's been a very interesting month to say the least. From a performance perspective, all 5 portfolios have delivered once again positive returns for the month. But what's really interesting about the different returns of the portfolios is they've all ended up almost exactly the same return percentage, no matter what portfolio risk profile you're invested in. Now, typically over the long term, we would expect a higher risk portfolio to be more volatile, but deliver greater potential returns. And the inverse would be correct for a more cautious portfolio. We would expect it to be less volatile and deliver lower return potential. This month, all 5 portfolios have delivered almost exactly the same return. However, how they went about delivering that return is fairly different. So at the start of the month, when the US and Iran were trying to come to some form of formal ceasefire agreement, there were issues with certain areas in the Middle East still being attacked, and therefore that ceasefire looked like it might be under threat. Now, as a result, the markets pulled back over a couple of days. This meant that if you had higher stocks and shares content in your portfolio, which you would expect in one of the more higher risk portfolios, then the overall portfolios pulled back a couple of percent themselves. As a result, these higher risk portfolios had to recover a bit during the month of June in order to deliver a positive return, whereas the more cautious ones didn't have to recover at all. So in front of you here is the graph showing the portfolio performance of all 5 risk profiles. And interestingly enough, the 1 out of 5, Zenith Cautious, has actually returned the most during the month of June at 0.64%. And the 5 out of 5, Zenith Global Capital, has actually returned the least for the month of June at 0.49%. And as you can see, the main reason for this was that around the 5th of June to the 11th of June, the markets pulled back and the portfolios behaved exactly as you would expect them to do so in such an event, with the more cautious ones pulling back far less and the more adventurous ones pulling back far more. The higher risk portfolios had to recover a greater percentage in order to deliver a positive return, and therefore have ended up slightly behind the more cautious ones for the month. No matter where you sit on the risk spectrum, you'd have seen growth over the month of June. For the last 12 months worth of performance, the portfolios all behave in line with what you would expect for the given risk profiles. The Zenith Global Capital portfolio, the 5 out of 5, has delivered 28.2% for the year. The Zenith Cautious portfolio has delivered 10.03% for the year. And all 5 portfolios in their respective risk profiles have delivered returns within that spectrum. And as you can see illustrated on the graph, the volatility associated with delivering those returns is proportionate to the returns that have been delivered. What I mean by this is that the greater the return of the portfolio, the more jagged and volatile the graph looks. We're seeing a lot of positive earnings reports coming out from We're seeing a lot of positive earnings reports and strong economic data being reported as we move through the year. This is a really good position to be in, especially given that the US-Iran conflict is now starting to subside. Oil has now fallen from around $90 a barrel and sits just under $70 a barrel as of this morning. Now, anything between around 60 and 90 is seen as a relatively healthy place for oil to be. So this would suggest that at least oil markets believe that the US-Iran conflict is generally coming to an end. What this means for markets in general is that we could hopefully see some of that supply constraint ease, and therefore there'll be less of an inflation concern moving forward. With stronger earnings being reported and relatively strong economic data being suggested across the West, this would be indicative of a positive environment for future growth. However, we don't have a crystal ball and anything could change at any moment. So it's really important, as ever, with any form of investment portfolio that we look to the next 5 to 10 years and not over the next 12 to 18 months. It's really important that we remain invested and stuck to a strategy that works and one that has high quality real assets like the ones in the Zenith portfolios. If you have any questions at all for either the Zenith team or your advisor, you are absolutely welcome to get in touch and put those questions forward. Thank you very much for taking the time to watch this market update, and I'll see you in around a month's time. Bye for now.